There's a subtle crack forming at the heart of the stock market's once irresistible engine, technology. For more than a decade, big tech and AI-fueled companies were the darlings of Wall Street, the stocks you couldn't afford not to own. Their meteoric rise pushed indexes to record-breaking highs, swelling retirement accounts and hedge fund portfolios alike. But here, in August 2025, something has shifted. Investors are no longer rushing headfirst into the tech train. They're stepping off, not in panic, not with the chaos of a bubble bursting, but with the quiet calculation of a strategist choosing a new battlefield. This isn't collapse, it's recalibration, a recognition that stretched valuations, fading margins, and economic headwinds are enough reason to pivot toward resilience. The market rarely rewards the same strategy forever, and the savviest investors are starting to diversify once more, reminding everyone that balance, long overshadowed by the Magnificent Seven, is back in style. In the US, the shift is becoming unmistakable. The S&P 500 has just entered its longest losing streak since January. The cause? Not broad weakness, but the weight of its heaviest hitters. Meta, Amazon, Microsoft, Apple, Tesla, Nvidia, and Alphabet, the titans that once pulled the index into rarefied air, are now dragging it lower. Each individual dip seems small, even ordinary, but together their collective decline exerts outsized pressure, bending the benchmarks they dominate. Analysts are calling it a healthy reset, a pullback from April's AI-driven euphoria. And here's the striking part. While the market cap-weighted S&P is showing strain, equal weight indices, where every stock counts the same, are holding up much better. The message is clear. Concentrated leadership feels thrilling on the way up, but when the tide turns, diversification is the lifeboat. The story doesn't stop in America. Across the Pacific, Asian markets are echoing this caution. In India, foreign institutional investors yanked more than 31,000 rupees, 0 paise crore, from 8 major sectors in early August, hammering financials and IT stocks hardest. Tariffs from the US and disappointing corporate results sparked the exodus, leaving India, once celebrated as a growth superstar, suddenly underweighted by global funds. The reversal is striking, not catastrophic, but it underscores how quickly international capital reprices risk when geopolitics and earnings disappoint simultaneously. Similar caution is rippling through other Asian economies, with global supply chains under pressure and protectionist policies clouding trade. Investors are pulling back rather than doubling down. Meanwhile, the spotlight shines brightest on the so-called Magnificent Seven. For 2 years, they carried markets on their shoulders. Now they face the uncomfortable scrutiny of bubble-like valuations. Some analysts whisper comparisons to the dot-com era, not identical but eerily familiar. Bank of America has flagged major outflows from tech-heavy funds, with capital rotating into small caps and equal weight strategies. The lesson is timeless. Markets that climb on narrow leadership eventually hit gravity. Unlike the dot-com darlings of 2000, today's giants are profitable, cash-rich, and deeply entrenched. But even the strongest names can become overextended when too many investors crowd in. The strain shows in the benchmarks themselves. The Nasdaq, heavily tilted toward AI and information technology, has stumbled sharply. The S&P 500, more diversified, still feels the drag of its tech titans. And while big tech hesitates, defensive sectors are stepping into the spotlight. Consumer staples, healthcare, and utilities, once overlooked during the adrenaline rush of growth, are now magnets for fresh capital. Their steady cash flows and reliable dividends feel like an anchor in choppy seas. A recent MIT study poured cold water on the AI craze, reporting that only about 5% of surveyed companies saw meaningful gains from generative AI investments. For all the rhetoric about revolution, the near-term bottom-line payoff is still thin. Investors, always more faithful to results than to hype, are trimming back expectations. This is where diversification reclaims center stage. Morningstar analyst Dan Lefkowitz has long argued that global balance cushions volatility, and investors are finally listening. Europe, Latin America, and pockets of Asia are outperforming expectations, while bond yields are offering real income again for the first time in years. Portfolios built solely on U.S. tech are giving way to global baskets of stability. History supports this shift too. The communication services sector, home to Alphabet, Meta, and streaming powerhouses, outperformed last year with lower valuations. Investors aren't abandoning tech entirely. They are reshaping it, integrating it into categories where steadier returns are possible. When you step back, the bigger picture comes into focus. Valuation pressure, geopolitical frictions, and fading hype are creating a climate where reliability wins over spectacle. Dividends, cash flow, stability, these are the new North Stars. But what does it mean for the everyday investor? First, don't panic. Big tech isn't disappearing. Apple, Nvidia, Microsoft, they'll still play defining roles in shaping the economy. But corrections remind us that even the strongest stocks need breathers. Second, consider this moment a chance to audit your portfolio. If you've been heavy in tech, trimming exposure by a few percentage points and redistributing into defensives or global names could add durability. Both Morningstar and Morgan Stanley stress the same point. Diversification isn't academic theory, it's a survival strategy. The coming months will be decisive. Fed guidance, Q3 earnings, inflation data, all will shape whether this is a temporary pause or the beginning of a deeper rotation. A rebound in fundamentals could reignite tech, but prolonged uncertainty will reward those already diversified. Either way, this moment proves a simple truth. Markets are never static. Leadership rotates. Narratives evolve. Fortunes shift. The investors who adapt to that reality will be the ones still standing strong when the cycle turns again. So let's be clear. Investors aren't abandoning the technology revolution. They're stepping back to measure hype against fundamentals, to ensure their portfolios can withstand volatility. It's not about fear, it's about foresight. And for those paying attention, that shift could mean the difference between chasing yesterday's rally and building tomorrow's resilience. And now the question comes to you. How are you positioning your portfolio in this new era? Are you still riding the tech wave, or are you starting to pivot into defensives and global diversification? Drop your thoughts in the comments, share this with someone watching the markets closely, and don't forget to subscribe, because the market never stands still, and neither should you.